How's it going, everybody? Tristan Powell here. Today in this video, we're talking about why mutual funds suck. Let's get right into it. So for those who don't know me, my name is Tristan Powell. I'm a 19-year-old entrepreneur and investor in British Columbia, Canada. In this video, I'm presenting you with 5 reasons why I do not invest in mutual funds and why other professional investors also steer clear of mutual funds. So before I kick off this video, I thought it would be a good idea to kind of explain what a mutual fund is. A mutual fund is an investment program funded by shareholders with a diversified portfolio that is actively managed by a professional investor. So in common people terms, a mutual fund is a gathering of stocks, bonds, ETFs, etc. in a single holding that when you invest a little bit of money into, you get a small piece of all of those stocks, etc. And now all of that is actively managed by a professional investor that will buy and sell the holding, the contents of the holding on his discretion. So reason number 1 why I don't invest in mutual funds is because of the fees they charge. Not only do mutual funds charge you a commission fee, like buying a stock or an ETF would, but they also charge you 2 other kind of fees. They charge you an advisory fee. So if you use an advisor to choose your mutual funds, they charge you for that. So an advisor fee can be between 20 and 50 bucks. It depends on your bank. The third type of fee, and this is the big hitter when it comes to fees, is your annual fee for having someone manage your mutual fund. So the commission fee is just the standard rate that your brokerage charges you per buy or sell a stock, bond, ETF, mutual fund, etc. My bank charges me $5.95 per buy or sell. The next fee, your advisory fee, can be between $20 and $40. Depends on your advisor or the bank, whatever you're with. So we'll just put 30 in the middle. So it costs a total of $35.95 just to buy one mutual fund. So after you've shelled out $35.95 or whatever your total will be, then comes the annual fee. So now onto the annual fee. The average annual fee for a mutual fund is 2.54%. So your mutual fund manager takes 2.54% of whatever amount of money you have invested in that mutual fund. So by some miracle, the stock market doesn't move and your initial investment remains the same. So let's say your initial investment was $100,000. Your bank is going to take, or your mutual fund manager is going to take $2,540 out of your account as his fee. So a lot of money, isn't it? It gets worse. So let's say the market had a terrible year. It's 2008 and all the stocks have dropped dramatically. Well, your mutual fund manager is still going to take 2.54%. So if your stock or your mutual fund dropped $20,000, so he's still going to take his 2.54% cut at the end of the year. Pretty crazy, right? So now, not only does your mutual fund manager need to beat the market, which is already a very difficult task, he now has to beat the market by 2.54% for you to see any gains at all. So here's an example of that. Let's say the market went up 8% in the year. Then they take their 2.54% cut. You are left with 6.46. So 6.46%. So you would have been better off investing in the general market and receive the 8%. So to even break even, your manager would have to beat the market by 10.54%. So you would have to get 10.54% to even beat the market's 8%. Ridiculous. And that 2.54% really builds up year after year. And I'm going to show you a diagram here of the Vanguard ETF mutual fund comparison. And it's very enlightening, to say the least. So here's the Vanguard Mutual Fund ETF comparison tool. I am not related to Vanguard in any single way. It's just a very convenient tool, and I'm going to put the link to this page in the description of the video. So here we got the Vanguard FTSE Canadian High Div Yield ETF, and then the Renaissance Canadian Dividend Mutual Fund. So on the right is the mutual fund, on the left is the ETF. The Renaissance Canadian Dividend Mutual Fund is a CIBC mutual fund, I believe. So we're going to start with an initial investment of $100,000. So this is where things get ridiculous. Looking down at this chart here where my mouse is now, you can see the fees of the Renaissance Canadian Dividend mutual fund is $2,176 compared to the ETF's $225 fee. Ridiculous. But it gets worse. As we get over holding for 10 years so, you have now paid $25,000 just in annual fees for your Renaissance Canadian Dividend mutual fund sold to you by the bank. Your ETF in that same time period would have been just shy of $3,000. And it gets even worse. Here on the other side is the growth. So it's not as bad as the fees, but it's still evident that the Vanguard ETF shows much better growth potential than the CIBC Renaissance Canadian Dividend. And it's not like they're holding different stocks. These stocks hold pretty much the same companies. So their number one holding, Royal Bank of Canada, so it's the same for both of them. They both hold TD Bank. They both hold Enbridge. They also both hold CIBC, so pretty much they hold the Canadian banks. Bank of Nova Scotia, Bank of Nova Scotia, Bank of Montreal, TransCanada, so that's the infamous pipeline company. It looks like the CIBC doesn't hold that one. This one also holds Manulife, Sun Life, and Pavina Pipelines, and the CIBC Mutual Fund does not. But all in all, they're both very similar, yet the ETF shows so much greater potential. The second reason why I will not invest in a mutual fund is because they're long-term investments only. That means you cannot day trade a mutual fund, you cannot swing trade a mutual fund, you cannot even hold a mutual fund for a single year. Most mutual funds even make you sign contracts to make you hold that mutual fund for 5 years, 10 years, 15 years plus. So I hate having my capital locked down in a single entity. The third reason I don't invest in mutual funds is mutual funds often underperform the stock market. In fact, 80% of all the mutual funds out there underperform the market per year. So even if they do maybe only 1% less than what the stock market does, who cares, right? No big deal. That's wrong. 1% every year can really add up. If you hold a mutual fund for 30 years and it's down 1% every year, you missed out on 30% of all those possible gains just because your mutual fund underperformed the stock market. The fourth reason why I don't invest in mutual funds is because there are so many better alternatives. You can get the ETFs like I showed you on the Vanguard Mutual Fund ETF comparison chart that I showed you earlier. So you can get an ETF that follows the market, or you can get an ETF that follows the auto industry. You can get an ETF for pretty much anything you want. The second better alternative is an index fund, which is a type of mutual fund, but it's more similar to an ETF. An index fund would follow the market. So your S&P 500, your NASDAQ, your TSX. And it just has less management fees that other mutual funds have. The third and final better alternative are blue chip stocks. So I got my blue pen for this. So investing in blue chip stocks that have good growth opportunity. So we're talking like Amazon, Microsoft. They have good growth opportunity for the future. So instead, you could skip all of them, ETFs, and just go right to the stock itself. The fifth and final reason why I don't invest in mutual funds is because it's kind of like a banking scheme. When people are saving for their retirement, the bank always insists that they get their RRSPs, or the US equivalent to those, actively managed. So the bank manages it. And that's how the bank makes a lot of money. Because imagine, people have these things for 30, 40, 50, 60 years, and then they're relying on that for their retirement. So rather than teaching people how to be successful in the market, banks are keeping people in the dark and doing it for them and charging them huge fees. So this is a little bit more of a personal reason, this fifth reason, but take it into account if you're considering investing in mutual funds. So don't invest in mutual funds. Invest in stocks, ETFs, bonds, etc. Take control of your own finances, take that away from the bank, and save some money for your retirement. Don't make the same mistake that so many people have made before you. Even possibly your parents might have made the same mistake of investing in mutual funds and missing out on huge possible gains for their retirement, of all things. So I want to hear your opinion now. I want to hear people from the other side saying mutual funds are good. I want to know why I should invest in mutual funds. Please leave a comment below on why mutual funds are good, or why possibly for another reason that I didn't mention, that mutual funds are bad. Thank you again for watching my video. I hope you learned something about mutual funds today. Like and subscribe, and follow me on Instagram at Tristan Powell. The link to my Instagram is in the description below. And see you in the next video. Good luck on the markets, everyone. I know you're somewhere, somewhere. I'm trapped in my